Welcome to the Wealth Without Wall Street podcast, your guide to understanding how to get out of the Wall Street rat race and start your own mailbox money lifestyle. Now, don't let the handsome Southern draws fool you. These financial minds are teaching our country to enhance savings, increase cash flow, and create passive income, all without the help of Wall Street. Are you ready to break through? Here are your hosts, Russ Morgan and Joey Murray.
In today's episode, we get one of those moments to interview somebody really, really smart. We're going to be interviewing PhD Robert Murphy. This man has written many, many articles in the economic community. He has co-authored a book, How Privatized Banking Really Works, which is a book I really love. I hope you'll go out there and purchase it. As well as he is a co-podcaster on The Laura Murphy Show and Contra Krugman. You're going to love what you're going to hear today because he's not only going to be telling us, is the stock market primed for a crash? Should we be putting money in Bitcoin? And also, is gold and silver really the things that we need to be looking to adding to our portfolio? But he's also pretty funny. We're going to get all into that today. Welcome, everybody, to the show today. We've got one of the nation's leading economists, Robert Murphy. And for many of you who believe this is going to be a maybe boring interview to be listening to an economist, it will be anything but. And I will say this too, Bob, I have not had the chance to hear you in person with your karaoke, but I hear it is extraordinary. And this year, when you come to Birmingham, I got to make sure to be a part of that group. Joey, help our audience know why having Bob on the show today is important.
Oh my gosh. Yeah, guys, I have had that great opportunity to get to know Bob over the years. Our affiliation with the Nelson Nash Institute has brought us together, read numerous of his books, and you guys are in for a treat. Like I said, or like Russ has talked about already, this is not your everyday economist. This guy is hilarious. So, Bob, welcome to the show.
Well, thanks for having me, guys, but you need to learn the phrase managing expectations. Now everyone's going to expect me to be like Dennis Miller over here, so I'll do what I can.
That's right. Well, you have that ability to produce, I have no doubt. And as we were talking a little bit before the show, our audience who listens to this on a regular basis is somebody who's really interested in how to grow their wealth. They're trying to run businesses, most of them, and they're looking for flexibility. And Bob, one of the interests I have is trying to figure out from your perspective, what's keeping the business owner, entrepreneur from achieving that goal from an economic standpoint?
Well, I think if we're talking about, in terms of more specifics, in terms of recent history, I think under the Obama administration, and it really was the case that the regulations kept changing, the rules kept changing, there were major overhauls, and I think business owners wanted to keep their powder dry, to use that cliche, and so that's why you saw that, a lot of these, even larger companies too, just were letting their profits, their net income pile up, and they weren't deploying it because they just weren't sure what the future was going to hold. And then also, of course, all the economic uncertainty in the wake of the financial crisis. I mean, we're truly in uncharted territory with the stuff central banks have been doing, not just in the U.S., but around the world. And so I think it's quite understandable, and especially when you add in, as the 2016 election approached, that it seemed quite plausible that Hillary Clinton was going to be the next president, and she was threatening all sorts of things that were going to increase taxes and regulations that would stifle small businesses in particular. So I think, given all that, it's not surprising that businesses were, reluctant to go out on a limb and to start long-term projects. And then, of course, we can go into these things, which direction you guys want to take the conversation, but more generally, just the whole financial landscape and where people end up putting their money and so forth, I think, is designed to keep it so that relatively smaller operations don't have a lot of options and they're dependent on outside financing, and that's also stifling things.
Right. Well, and you've authored many, many, many books, and I've read a lot of them. And the one I haven't had a chance to read, but I was looking through your bio that really intrigues me, and I don't know why I haven't seen this one yet, is The Politically Incorrect Guide to Capitalism. I imagine that's going to be one of those things that a business owner would resonate with.
Well, yeah, I mean, I encourage everyone to buy all my books. Yeah, it's the premise of that for people who haven't heard it. It's out of Regnery Publishing, and it's a whole series, the Politically Incorrect Guide series. My friend Tom Woods had the first one that ended up being a New York Times bestseller, The Politically Incorrect Guide to American History. So the premise of the series is it takes things that are, quote, shocking, in terms of the conventional politically correct culture in the United States, but then they have an academic who sits there and then justifies all these claims. So like mine, for example, since it's the Guide to Capitalism, saying things like, it's fair that a pitcher in the major leagues makes more than a teacher. Even though a lot of people think, oh, what kind of sick society do we live in where school teachers make less money than some guy who can throw a fastball? And so I walk through and explain, well, no, actually, that does make perfect sense once you understand how pricing works and, what it means for something to earn a certain income in the market. Things like that, like the fetish for recycling and things and why that might be misguided, stuff like that. So I just go through in the book and take on certain sacred cows, as it were, but doing it in a way that it starts out with a provocative claim, but then by the time you read my analysis, you realize, oh yeah, that makes perfect sense.
I gotcha. By the way, too, for our interview, I was recounting some of your Facebook posts, and today's post is, as usual, is perfect, spot on when your son and you were having a discussion about FDR. And Joey says, I didn't see that post. And so I think he went to befriend you on Facebook and realized that you're capped out. You don't have any room for him. And I mean, I'm not trying to rub that in his face per se, that I'm in the group and he's not.
I appreciate
but
that.
I'm sure Joey's not the only one who's been trying to get in on this Facebook group.
Well, since you bring it up, I do want to clarify for people. Facebook is weird. So on your personal account, they'll only allow up to 5,000 friends. And so, back in the day when I was just like that, was serving a dual purpose, like literally my high school friends and family and stuff. And then people who knew my work were friending me on Facebook. But then as that limit approached, people said, you know what, you need to start a professional page. And so I did that. But what's weird is I'm not actually at that 5,000 limit now. But Facebook also has this separate thing where if too many people request you in a certain period, it cuts you off too. So it's tricky.
So you're saying there may be a chance for me?
So yeah, you're saying there's a chance. Yeah. Just have your people talk to my people. We'll try to make it work.
Will do.
Yeah. See, Bob, I treat Facebook more like a scarcity mindset. I have just a very close knit group of people. Every time I get a request, I'm like, do I know you? How do I know you? And then Joey's like, you got like 117 people. This like, do you not have friends?
Yeah, well, in all seriousness, I did try to distinguish the two because there were situations where like somebody from my high school would, if I said something on somebody's post from my high school, then all of my libertarian friends would see that, like it would show up and then they might pile on the person. And so I realized like I don't want to be releasing the hounds of, crazy libertarians on somebody because they posted a picture of their kid or something. So
yeah, no, I've been there and done that. I've got, people I knew in high school that, probably think a little bit. We thought very similar in high school, and I've changed in my thought process as time's gone on for the better. And maybe some of them are kind of where they used to be. And I've had that same thing where they've mentioned something and I've gotten like a buddy across the country that jumps in. I'm like, whoa, hey, don't, it's not worth your time.
Not that I don't want to continue to talk about Facebook, but I think this is a great opportunity, Bob. A lot of our clients are asking questions about things like Bitcoin and just these hot topics that are coming around. And in your book, How Privatized Banking Really Works, one of the main topics you talk about is the fiat currency, where we're at right now, being separated from the gold standard back in the 70s. So just around that, it's a hot topic. Love to just have your thoughts on Bitcoin and how that affects today's business owner, or if it affects us at all. Just your thoughts on that.
Sure. So let me mention before I forget that I have a co-authored guide to Bitcoin where we assume no prior knowledge and then take it as deeply as you want to go in terms of understanding the actual, things like private key and how do you sign up, a transaction so that the ledger recognizes it and all that kind of stuff. And then also the economics of it. So it's at understandingbitcoin.us is where that free guide is for people who want to learn more about the mechanics. But for our conversation right now, the promise of Bitcoin and why so many libertarian type people liked it in the beginning when it first came out is that it's what was called a peer-to-peer payment system, meaning you didn't need any trusted third party. So for years, there have been proposals, like Friedrich Hayek had something in his book, The Denationalization of Money, where he was saying, it's not that fiat money per se is necessarily bad. It's just that it's been monopolized by governments. And so, I could imagine. And so Hayek has this proposal for a bunch of separate firms issuing their own currencies. And then, if the public wants to adopt them, they can. And so as long as there was no coercion, legal tender laws, things like that, Hayek was saying that would be a much better system than having a bunch of states issue their own fiat currencies. And for your listener, I'm sure most of them know, but again, a fiat currency means it's not backed up by any normal commodity, the way like under the gold standard, gold was still used for industrial purposes or jewelry, and it was also the money. Whereas right now, the U.S. dollar is just a green piece of paper. You can't turn in your dollars to get something else. If you turn in a $20 bill, they'll give you 2 tens. Whereas under the gold standard, you turned in dollars, they would give you actual yellow metal. And so Hayek had that proposal. But even there, the problem was always you had to trust the company that was issuing these notes. And what if they were nefarious, or what if somebody hacked into them or what have you? So that's what the promise of Bitcoin is that there's no one in charge of Bitcoin. There's no one person doing it. It's sort of like saying no one's in charge of physics. You know what I mean? Like no one can hijack the entire thing of physics. It's just there's thousands of people around the world that kind of maintain its integrity. The same thing with Bitcoin. Thousands of people around the world maintain this public ledger of transactions of exchanging Bitcoins. So that's what's kind of neat about it, and it's an interesting curiosity. And then as everyone knows, this year in particular, within the last 12 months, I mean, it's just skyrocketed in value. I don't know that there's any, in terms of the fundamentals, explanation for why it shot up so quickly, and it wouldn't shock me if it came down. So I think it is a very volatile thing still.
Is it not kind of like a lot of the other things that we're seeing in Wall Street right now? It's just right now it seems to be really emotionally based.
Well, for sure, I think a lot of people have gotten into Bitcoin in the last 6 months just because it's been going up so much. And I mean, and that's the standard definition of what does it mean for something to be in a bubble, where, now people are buying into it because the price kept going up. And so now that it's leveled off, you're wondering, is it going to crash? So, I mean, I have some Bitcoin that I got into, and, I was happy to see it go up. And I don't know whether it's going to be Bitcoin, but I think 100 years from now, for sure, cryptocurrencies are going to, everyone around the world will be holding them. I'm not saying that they're going to displace more traditional forms of money, but I think everybody's going to, have some cryptocurrency 100 years from now, just like most people now have credit cards.
Right. And I think that probably whenever you start seeing some of these major retailers or people where they're buying goods, if they start accepting that, then I think that's where you're going to see that stuff really take off, I would guess.
Yeah, and that's part of I don't know how much inside baseball you want to get. That's part of the debate right now within the Bitcoin community is it's sort of like it was plagued by its own success that for technical reasons right now, they can only have something like 5 transactions a second. I think I'm in the ballpark. I forget what the exact number is. Like with the way in terms of adding what's called blocks to the blockchain and the technical limitations. And so there's no way, it become in the current protocol, there's no way that it could like displace Visa or MasterCard. It's just not technically capable of doing that. And so what's happened is the fees you have to pay to have your transaction go through the normal Bitcoin network have gone up. And so it's kind of like, if the goal was to make this a currency, a way to send payments with relatively low cost around the world, which is what in the original white paper by Satoshi Nakamoto, that, the pseudonymous guy who proposed Bitcoin back in I think it was 2008, that vision is no longer being satisfied. That right now it's actually more expensive to send payment to people with Bitcoin than it would be to use PayPal or something. So that seems kind of crazy to people. But again, it's this weird, it's like a Groucho Marx thing, like, or Yogi Berra, I should say. I'm getting my anecdotes mixed up. Like, no one goes to that club anymore because it's too crowded. It's kind of like that, where it's like, no one can use Bitcoin as a payment system right now because too many people want to get into it and hold it for, it's a speculative asset because it's going to appreciate. So it's this weird thing.
Yeah, I mean, that's the thing right now. I think as we kind of led into this, our clients are seeking freedom. They're looking for ways to take charge of their financial lives. And then there's, as you've kind of already touched on, the idea of sound money and the lack of trust maybe we have long term in our current system. And then now you're introducing Bitcoin, which, by the way, because I've read a lot of your stuff and I've gone and watched lots of videos on it, I could understand what you just said, but I could tell you 6 months ago, most of the things you just told me would have been completely confusing because it's like blocks and chains and what are we talking about here? The average person who is working as hard as they possibly can to grow their business, to feed their family and everything else, it's like, how am I going to figure out this? This is just adding to the stress level that exists out there. We're trying to figure out ways to simplify that. In your opinion, when you're looking at ways, because I know you get hit up all the time, hey, Bob, I know you're following the markets. I know you're following where we are in our country's progress, if you will. Like, what are some simplified ways? What are some things that I need to absolutely just avoid? And then maybe are there opportunities that you're seeing that maybe I need to take advantage of? And I'm not asking you for your hot stock tip here, but just as an economist, I'd love to hear your viewpoint because I think that's some of those base nuggets that people who are listening right now are like, yeah, what do you say?
Well, sure. So what I would do is point people, my business partner and co-author Carlos Lara and I think it was 2 Septembers ago. I'm getting the years fly by now. We had a thing called How to Avoid the Coming Financial Storms. And so that's at our website, laramurphy.com. And that's LARA and then a dash Murphy.com. And just the takeaways there is we said for people, but in particular business owners, we were saying you really need to investigate Nelson Nash's infinite banking concept and get yourself a properly designed whole life policy to serve as a sort of quote alternate bank so that you can start flowing your excess saving, any excess money you have that you would normally leave in a checking account or whatever, put it in this thing instead. And then as that thing accumulates, now you can go to that as a source of, short-term liquidity when you need it. So that would sort of wean yourself off of dependence on like a bank line of credit, things like that. So that's, something like Nelson is obviously big on. And then the thing that's more just coming from Carlos and me is we're just very concerned about the fragility of the banking system right now. And with Dodd-Frank, it is clear that there's not going to be another taxpayer bailout if the banking system seizes up again. That they're going to do what's called a bail-in, meaning that the creditors and shareholders are the ones who are going to eat it in case a bank, is underwater. And so what does that mean? That the depositors are going to be on the hook. And we've seen precedents in this. This isn't just science fiction. I mean, it happened in Cyprus. And so because of that, we think people should have a bunch of, like a month, let's say, of actual currency in their possession, just in case, the bank shut down, in case you lose access to your checking account. Even if it's temporary, that could be crippling for a business owner. You can't get to your money. And so we think people should have an actual stockpile of literal cash. And then we also advise, having some amount of gold and or silver in your physical possession, just in case, the dollar does crash. So it's like a defensive strategy. So I'm not saying your whole portfolio should be everything I just went through, but I'm saying those things, if you did that, you would be in a much more defensible position for these various possible shocks that could occur, over the next 5 years, let's say.
Yeah, that's great, Bob. Thank you. I mean, as far as giving people a real tangible plan, we're all about action, not just, taking in information. I think there's enough information out there. We just need some direction and some action because, as we mentioned, so many of our clients are looking for control, but it seems like less and less is controllable as it relates to banking, as it relates to where we're investing and putting money to work. Those things are, as you mentioned earlier, Russ, very emotionally driven in the stock market. That's why this podcast exists. We're trying to give alternatives to Wall Street that people can then take back some of that control and make wiser choices. So thank you for that. Anything else, Bob, that you would see as a trend right now or as a potential pitfall that people may not be seeing economically that's kind of under our noses?
And maybe I'm going to point you, if you're not already following, Bob is, as I mentioned before, multi-talented and is on different media. And he has two different podcasts. And I follow the Laura Murphy show. And several episodes ago, you mentioned the potential for a bubble in the real estate market. I don't know if that's where you're leading, Joey, but I know that was one that I was pretty interested in.
Yeah, thanks for the plug there. So yeah, it's the two podcasts. One is called Contra Krugman, and the other one's the Laura Murphy Show. And yeah, so Carlson and I do think we're very concerned that the stock market and real estate, in the United States right now are above their fundamental values, if you want to use that kind of language. Just meaning we would not be surprised if there was a sharp correction in both of those in the near future. That we think that what the Fed has done since 2008 has fueled bubbles in those two sectors. And so, as now the Fed is tightening, explicitly raising interest rates and so forth, that standard Austrian business cycle theory says that, the boom bust cycle comes from central bank manipulation of interest rates and pumping in credit that causes a false boom. And then when they tighten up, there's a crash. And so, that's textbook of what they've been doing since 2008. So unfortunately, I do think that the U.S. economy has been set up for a big crash.
Yeah.
And I know that's not great news for the person who's listening, but somebody said long ago that there's no good or bad news, it's just news, and it's how you prepare for it. And it sounds like what you kind of gave as a plan, as a strategy early on can protect somebody in that measure. I do want to ask a question because, a lot of our followers listen to your two shows. And I've been asked, Russ, Bob was talking about having 6 months precious metals in my possession. I think that makes some sense. But I've also listened to some other shows out there, and they've talked about the fact that, we're all big on how the bank can, multiply money through fractional reserve banking. And there's people out there saying that the banks are doing the same thing with gold. So what's Bob's stance on should I hold this gold at a bank? Because if they close their doors, because that's where most people think to keep their money is in a safety deposit box down at the local bank. What's your opinion on that?
Right. Great question. So there's trade-offs here. And with all this stuff, obviously people have to tailor it to their own particular situation. That, there's not this one rule that applies perfectly to every single household or business owner. Yeah. So when we say in your physical possession, we don't just mean, don't have an ETF that's in gold or don't have a bunch of stocks in gold mining that, you want to have the actual metal. But yeah, even there, ideally you would have a safe at your house or something and you'd have it there. Now, the flip side of that is, well, geez, if that's we're talking about a pretty valuable thing there. And what if my house burns down, or what if somebody breaks in and steals it from me? Like, isn't it safer in a safe? So yeah, there's a trade-off and you got to weigh the pros and cons. But my concern is that, yeah, in the kind of situation where you really would be glad you were in gold, like where the dollar crashes, let's say, then, it's conceivable the government would do all sorts of, quote, emergency measures. And that might mean things like, a freeze on gold, because they'd say, speculators are shorting and that's what's hurting the dollar. And we got to, stop these profiteers. This isn't science fiction. FDR literally at gunpoint made people turn in their gold, so it's, there's all kinds of stuff they could do in a panic where the stock market crashes and real estate crashes and the dollar falls. And, all of a sudden the things at Walmart are 30% more expensive overnight. You could imagine the public going along with all kinds of proclamations. And if they said that, the banks have to seize the, gold that's people, and not even necessarily like take possession, but just say, there's going to be a freeze right now. You can't get into your safe deposit box until things settle down. You could imagine them saying something like it. So that would defeat the whole purpose of you having that gold if you can't get at it. So that kind of stuff.
I think that, that's the hard part, is knowing where to store it. And then what to do in the meantime while trying to think not from a complete defensive mindset. Because I realize that there's a lot of just craziness going on around us. And you continue to just point out flaws to me as I read and listen to your stuff about what's going on in the marketplace. And it's interesting, you see the market's high as we're sitting here at the beginning of 2018. And everybody's like, look, see, the market did great last year. If you're not in it, you're talking about building wealth without Wall Street. You're missing wealth. What do you say to the person who's talking to you about the stock market right now in such a kind of like, man, you're stupid that you're not like full on board of this, because this is where people make money, is when things are going up.
Well, sure. And that's what I was saying before about the defensive strategy. And I was saying, this isn't 100% of your portfolio. So particularly, if somebody's young and he has spare wealth where, in other words, he's got the cash flow coming in and he has a bunch of reserves. And, even if certain things dried up, he's got 6 months worth of liquidity and really truly safe assets. And he wants to get exposure to the S&P 500 or something. I'm not going to say that that's a wrong thing to do. I guess I would say, though, that for anyone who's even remotely an adherent of the view that free markets tend to allocate resources better than top-down central planning, I mean, just look at the stock market performance during the Obama administration. That doesn't make any sense, right? They had 4 years in a row where the federal budget deficit was higher than $1 trillion. 4 years in a row. They, increased the government takeover of healthcare and health insurance. They, had a so-called clean power plan that restricted coal-fired power plants. The minimum wage increase, right? So there are all sorts of things, any one of which in normal times would have been, quote, bad for the economy. And also there was not a single year where real GDP grew more than 3%. This is the first administration where that's happened since the Hoover administration, I believe. So the economy was terrible, in terms of labor force participation rates, things like what percentage of people that are between 16 and 25 who are actually working plummeted, and it hasn't recovered. So by, all sorts of, quote, fundamental normal measures, the economy was in really bad shape and didn't really recover during the Obama years. And yet the stock market went through the roof. And so, to me, I think that's an indication that there's a mismatch there. And if you say, well, what could explain it? Well, the Federal Reserve, the Fed pumped in more money into the financial sector in 6 months under Bernanke than it had in the prior entire history of the Fed.
Wow.
That's just a fancy way of me saying the Fed doubled its balance sheet in 6 months, but it sounds creepier to say it the way I just did. But the point is, when we say they did unprecedented things with those rounds of QE, that's not hyperbole. It's, if you've seen charts of what the Fed did, its balance sheet, it literally looks like a typo. Like it just goes straight up there in the tail end of 2008. So I'm just saying that it's the story that we're telling about why the stock market is overvalued, I think is quite defensible. And you can even see too, it's that when the rounds of QE would stop, then the stock market would start dipping. And then it would go up again once they would announce a new round of QE. So, the connection between QE and the stock market was pretty tight. So now it's true, since Trump got elected. Well, let me back up a second. So from the fall of 2014 onward, and that's when the taper had fully kicked in and the Fed was actually not inflating, and when they were just rolling over their assets, the S&P 500 just kind of tread water. Like it really didn't rise much from the fall of 2014 up to the election. And then when Trump got elected, it's true the S&P 500 went up. But if you think about it, that kind of makes sense, because compared to a Hillary Clinton administration, the Trump administration is extremely business friendly.
Right.
Not to mention, the big corporate income tax cut they just pushed through. So, my basic view is that the overall level of the stock market is way too high, but it does, the short-term movements do kind of make sense. That given whatever you thought the stock market was when you thought Hillary Clinton was going to be the next president, it would make sense that you would revise upward your valuations now that Trump's in there. But still, I think that the Fed creating money and pumping it in and buying government bonds and mortgage-backed securities that were called toxic assets, I don't think that's the path to prosperity. That can't possibly make us better off.
Yeah.
Well, that further confirms, Bob, again, just the emotional aspect that drives Wall Street. Everything that you just mentioned is all, what do I feel about the economy right now? What do I feel is the direction that we're headed? So, yeah, you're exactly right. And we shouldn't be surprised by some of these short-term gains that we've seen in those places.
Well, Bob, we've only tapped your knowledge in this area, and I hope that you'll give us another opportunity to be better interviewers, because we're still learning that process as we were learning just how to have this conversation online, because normally we're sitting in our office here having this around a round table. But will you come back and let us do this again? Because we've only scratched the surface of the things that we would love for you to share with the people who are listening.
Yes, I would definitely come back, especially since your listeners are probably like, so when is this guy going to get funny like they promised? So, yes.
Well, that's it. You know, again, leading to what we just talked about, we're seeing, I feel like, emotional pressure for people to jump in the market because everyone else is doing it and they're seeing success. And it would be like me following you on stage at karaoke, watching how great you are and thinking, oh, well, I mean, that seemed great. And everybody else is saying, why don't you go do it? I mean, if anybody has ever heard me sing, as you already
that does not end well, folks.
No, it's not going to go well. Well, thank you again so much for your time. I know you have so little of it to share, and I really appreciate you being so generous with us. And look forward to catching up with you next month when you're here in town.
Great, guys. Thanks for having me on. And yeah, sure, I'd love to come back.
All right. Thank you so much.
What a great show. Thank you for joining us today. And make sure you head over to wealthwithoutwallstreet.com. Check out the show notes for the links that we discussed. And be ready. Next episode, we're going to be interviewing a local CPA, and he's going to be talking about how the tax reform of 2018 is going to help or hurt us. You won't want to miss it.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your terms in places you understand so that your wealth will never run dry. See you next episode.